You into this Zoom room today. I'm Sarah Rodman Alvarez. I direct the Randall Lewis Center for Wellbeing and Research at University of Laverne. And we are increasing our programming around financial well-being. So we think about well-being as sort of a wheel with different areas: physical well-being, mental, emotional well-being, and financial well-being is in there. And thanks to a grant from the federal government, a Title V grant, and some private monies, we are starting to really expand these offerings to students, faculty, and staff. And we are so excited to be able to do that. And one of the reasons why we're able to do that this semester is because of our illustrious presenter, Rick Hasse, who I'll introduce in a moment, faculty in CBPM. And it's just wonderful. So keep an eye out for more and more programming to come. At the end, we'll let you know about the other couple workshops that are happening at the end of this semester, but there'll be more to come next year and the year after. So we're so happy to have you here today. Just a couple of housekeeping issues. Try to keep yourself muted. If you have questions, please feel free to use the chat. We will have time for Q&A at the end. And Lexi Flores is going to put a link, it's right there in the chat, to mark attendance. If you would please click on that link and mark your attendance, it would mean so much to us, just so we can see who's coming, show that, these events really do matter to people, and, perhaps in the future, send you some brief questions about how'd we do, and what would you like to see more of in the future. So please mark your attendance. I think with that, I will introduce Rick Hasse. So Mr. Hasse has been working for over 35 years in the accounting and finance field. His career has included management in both profit and not-for-profit companies. He's taught undergraduate and graduate courses in finance, accounting, and statistics at the community college and collegiate level. He's a member of the faculty in the College of Business and Public Management at University of Laverne since 1990. He also has taught at the Claremont Colleges, Ithaca College, and Tompkins Cortland Community College. Mr. Hasse currently writes a bi-weekly blog entitled Rink Rats, which I've seen, and it's amazing. Financial management experience includes mergers and acquisitions, corporate finance, and investment banking in industries including not-for-profit colleges, medical supplies, real estate development, and transportation services. He has an MBA in finance and accounting from the University of Laverne, and a BA in economics and government from St. Lawrence University. He lives in Claremont, and his passions are writing, golf, hockey, and investing. And we are so excited to learn from him today. And with that, I'm going to turn it over to you, Rick.
Thank you, Sarah, and welcome everybody. And I see by the participants here, there's a lot of old faces and former students and staff that I know quite well. And thank you for being here today. And thank you, Sarah and Lexi, for giving me the opportunity to develop these workshops. I think this is a much needed thing in our community of University of Laverne, both for students, for staff, for even faculty, and the community to learn about new things and get up to date. I mean, you wake up every morning and you turn on NPR, or you wake up every morning and you turn on God save us, Fox News or whatever, and you listen to the news, and the news evolves around basically economics, the markets, and that's what the world goes by. You get on your cell phone all the time and you see apps and information, and sometimes you wonder, what is all this? What does it do for me? What is this? What can I take advantage of this? And that's one of the purpose of these workshops, is to make this information make a little bit more sense, and help you be able to understand what's going on in the financial world around us. A lot of us are experts in our chosen fields in what we do for a living, or if we're a student, we know exactly what's going on in our own world, but to understand what's going on in the world around us in regards to economics and finances makes you feel more comfortable, makes you feel better about the future, and can help you. So I thank you again, the Lewis Center, for organizing this, and we're going to hopefully make this a common thing going into the future. So our topic today is on financial markets. And we're going to be basically talking about the basics, what they are, why we look at these or why we want to be involved in them, and what they provide us as individuals in the market and in return to us. Naturally, all of us, either if we're a student, if we're a staff member, if we're a faculty member, if we're a member of the community, the financial markets are a place where we can, for lack of a better word, stash our cash. But stashing the cash is a key thing. How much cash can we stash is a big question. And it all has to do with your own particular personality, your own particular way of doing things, and what those mean to your own world. And we're going to be talking about these things. What the key to understanding the markets is these 5 things. The bottom line is you need to feel comfortable. It's just like going into a classroom with a new professor, or just like driving a new car, or just like going to a new store or watching a new television show. It takes you a while to warm up to it until you feel comfortable in what's happening. Well, it's the same thing exactly in financial markets. And my experience over many years is the more I'm comfortable, maybe the greater risk I could take, or the more I'm comfortable, I don't have to worry about it. I can go about my daily life and not worry about it. So I think if you stick to these common things, you'll be better off. Do your homework. If you just have some extra money and you want to just set it aside, pick a savings account, pick a bank to do business with. Make sure you understand what that bank is all about. Make sure you understand what's that company that's going to represent you and take your money is all about. Do your homework. And one of the key things is common sense prevails. Basically, common sense. Are you going to put your money in an investment that you know nothing about, have no history with, just doing it because everybody else does it or everybody else has this app, so I'm going to do it too? Don't do that. In the long run, you'll be hurt. Hurt meaning you might lose money. You might be taken advantage of. And that's the key thing. Keep it simple. Keep it simple in relationship to yourself. Now, if you're a business administration major or an MBA student or you work in business, simple means a different thing to you than somebody who's has no experience and no daily life in business. Keeping it simple in your own world is very important. It's just like when we're on campus in the old days a year ago. Matter of fact, a year ago this week. How about that? Is when we could go to the Lewis Center and work out, or we could go to the gym, or we could go for a walk, or we go for a jog. Our life was so much simpler because we knew exactly what we were doing because it was the same thing day in and day out. We could go to the workout and work on weights and do the treadmill, and everything was simpler because we were in control. Investments are the same way. The more simple it is to you, the more in control you are, the more you can relate to what's happening. Now, naturally, if you have a little bit more experience and feel comfortable, you can go up a notch, maybe get a little bit more sophisticated, a little bit more risk. But in this beginning part, you want to keep it simple. And then understand the risk. What's the risk involved? Naturally, if you keep it simple and you put money into a savings account, the risks are minimal. You're protected. But if you buy and get a Robinhood amp and you start playing around in the Bitcoin market by buying slices of Bitcoin, and some of you might know what I'm talking about there, you're taking more risk because that's more of a speculation type deal. And we'll talk about that in a little bit. And then also have some idea in your mind, what is your short-term goals and what are your long-term goals? Now, if I was a student 20 years old today, my short-term goals are, well, I just want to make sure I have enough money to pay my expenses. I want to sure I have enough money to pay for education and enough money so I can go out with my friends now and then and maybe put gas in my car and that sort of thing. That's a short-term goal. But also your long-term goals, if you are a student or even a staff member, is what do I have on the horizon? If I'm a student, maybe I have a student loan that's out there that 6 months after I graduate, I have to pay. Maybe if I'm a staff member, maybe I'm thinking about getting married, or I'm thinking about having a family, or I'm thinking about buying a car or a house. Your goals, your risk The nature of your investments, the nature of the markets you're going to participate in will be driven by what are your goals, both short-term and long-term. And see if you can establish those. That's a key too. And there's a set of principles in the market, the set of principles in finance to establish maximum value and return to your net worth. You want to make money. You have an investment principle. You want to have an investment return. You want to make money off that investment over time. And you want to stay ahead of inflation. You want to have that investment equal opportunity value. If I take $100 out of my savings account today and put that $100 into Bitcoin, okay, $100 into Bitcoin, okay, I'm probably going to keep up with inflation. But could I be using that $100 elsewhere instead of putting it in Bitcoin? Could I be putting that $100 towards paying off my credit card debt? Could I be putting that $100 into donating it to a charity that I care very much about? Could I put that $100 in and helping out a family member? You have to establish your opportunity value as well. And that's a key thing in understanding the markets. Do I want to use this money for long term? Do I want to make a quick dollar? What are my investment principles? Naturally, you always want to stay ahead of inflation, and inflation right now is anywhere from 2.5% to 3%, even less. But at the same time, what else could I be doing with this money? That's important. And naturally, the financing decision is, where's the money going to come from? Probably for most of us, from paychecks. From if we're a student worker, we get some extra money. What am I going to do with that? Paychecks, other income. Maybe you might inherit some money for some of us. Maybe you have a second income. Maybe you get some money from your parents, from your grandparents, whatever. What do you need for day-to-day expenses versus what can you put short-term or long-term aside to maximize value and growth? And then what are you going to do with the growth once you get it? All right. What are you going to do with the investment returns? Are you going to reinvest it? Or are you going to take those investment returns and put it towards a new car, or put it back into your savings account, or give it to charity, or whatever? So all these three principles are very important to understanding the markets because they guide you in your decision making. They guide you in keeping it simple to understand these things. A key word in the financial markets is risk. All right. Risk. And I tell my students in finance classes and accounting classes all the time, there's nothing wrong with taking chances, but do you understand the downside of taking those chances? You can start with the very simple investments in the market called money market funds and savings accounts. It's guaranteed by the federal government. It's guaranteed that if that money is lost, you get your money. But because it's low risk, the return is very minimal. And I'm sure a lot of you out there in internet land have investments and have money in a savings account, and you see that your account balance at the end of every month, and oh, I got 2 cents this month in savings. Wow, a landfall. It's very minimal. Why? Because it's risk. It's less risk. It's liquid. You can get at it anytime you want. And then you start going up the ladder. Notice this ladder here. We go to debt, lending people money. Who are those people? The United States government. Municipalities, corporations. We lend them money through the bond market. Now, we're not at that stage in our investments where we can lend $1 million to General Motors, or give the city of Laverne $1 million to build a new sewer system, or give the United States government $1 million so they can pay off their debt. But what we do is we put it in investment funds, in mutual funds. It's called fixed income investments. Why? The principal stays the same. The return is the interest given off that cost of borrowing the money. Mm-hmm. The return is the interest. Now, you can sell debt before it matures, comes due, and maybe play the gain or loss market. But most of us buy an issue or issue debt or give money and invest in debt mainly for the interest, and it's guaranteed. If those companies default or those institutions default, you get your money first before everybody else. That's why it's less risk. And then you can invest in the next level, which most of us do because it's sexy, it's exciting, it's in the news all the time, it's public relations for the companies. I mean, does a day go by where Elon Musk doesn't brag about Tesla? He's keeping pretty quiet these days. Tesla's gone down a little bit the last few weeks, but it's a public relations for companies, how their stock is doing, how they're doing. And the stock is you're an owner. When you buy bonds or even when you put money in a savings account, you're giving your money to that institution in return for interest, and you get your principal back whenever you need it. But in stocks, you become an owner. I own 1 share of Apple. Wow, you're an owner. That's pretty cool. But being an owner, there's risk. You can lose it very quickly, or you can make a lot of money if that company does well. And these days, especially today, the market had a record day in the Dow Jones Industrial Index. But lately, people say to me, Rick, geez, the Dow is doing very well. But I've been losing money in Apple lately because the markets are changing all the time. The markets are going by what the economy is doing. A lot of you in the next couple of weeks are going to be getting a check in the mail or a check deposited into your account from the stimulus bill that was just passed today. What are you going to do with that money? Are you going to just pay off your credit card, save it to pay off student debt? Or are you going to spend it right away? Or are you going to invest? That's your personal decision of what you need that money short-term or long-term. And you could put it into stock funds, equity, where the risk is greater, but the return and the loss can be just as greater as well. And then you could speculate. And that's all you hear about on the news these days. You can buy Bitcoin. You can invest in currencies. You can buy stock options. You can buy futures. We're not going to get into the details of that because everybody who's listening to this call or this workshop today probably should stay long away from those things. We don't have that kind of money to afford to lose, do we? I know I don't. Yes, you can dabble in it a little bit, maybe a couple $100, but that's where your growth is not going to happen because it's too risky. You get a paycheck, you want that money to last. You pay your expenses, then you want whatever left over to last, either in a savings account or whatever. So how we anticipate the risk is understanding the markets as well. This is my high-tech slide. What is your objective? As in this case, this investor is jumping up and down so he can see how much money can he make? What's the maximizing of his return? You see that in there in that dollar bag up at the top of the desk. He's jumping up and down to see what he needs to do and what is that return. That's all of us. Oh, I'm playing the market today. I just bought a couple of shares in a mutual fund. Why did you do that? Well, I think it's cool to own stock, but also I want to make a lot of money. Okay, fine. But then part of your objective has to be, as I said earlier, are you comfortable making that investment? And here's another key thing that a lot of us think of, and I know I do, and I know a lot of students who I talk with about investing in the markets. What are you going to invest in? Are you going to invest in companies that are socially, economically responsible? Do they take care of their employees? How are they with the environment? Are they ethically sound? Do they have a track record of hiding taxes? Whatever. Ethical decisions are also involved as you go up and invest in the markets. Do you want to invest in companies that are responsible to society? And I know for a lot of us, yes is that answer. Very much so. So that's a key part of that. But again, back to the risk. What is the market risk? This past week, in the last couple of weeks, there's been a change in the market risk. Interest rates have begun to hedge up a little bit. That's why the stock market has changed dramatically. People are selling their shares in Apple, in some of the high tech stocks, because why? We're coming out of the pandemic. The need for no longer to have a computer or to invest in computers or technology, because we're getting ready to go back to work. So people are selling off Apple thinking, okay, Apple's made their money in the last year. Now I'm going to change and go someplace else. The markets are constantly changing. And as an investor, as a watcher of all this, you kind of see the big picture. And those leading indicators that we're going to talk about in a little bit are going to be it's like a scoreboard to tell us where the market is going. Right now, the risk in the market is a little bit lower because we've changed presidents. That made a lot of difference. For some people, no. Some people, yes, depending on how you voted. But the overall market has relaxed because everything's less tense. The events of the changeover in the presidency, the things that happened in the Capitol, that added a lot of stress, but now that stress is beginning to be diverted. And that makes a big difference in understanding the markets too. What's the stress in the market? Are people nervous? Are companies nervous? Is there a possibility of a war? Is there a possibility of high inflation? These drive the risk in the market. And that leads us into to understand the markets, you have to have some idea, and I know a lot of us do, is what's going on in the world around us. Today, naturally, the big news is the stimulus package. Then there's going to be massive changes over the next few months in our infrastructure, more money being spent on infrastructure. If I was somebody wanting to play the stock market today, I would think about investing in companies that are going to benefit from all this new money coming into our economy with stimulus checks. Where are people going to spend it? And what's going to happen with all this new money in infrastructure? You might want to think about investing in construction companies, thinking about in companies that are going to take advantage of all this new money coming into the market. What are the business activities, international trade? What are the social and political environments of the world these days? Things have calmed down a little bit, but at the same time, there's always that friction between the United States and our economic ways of doing things and what's going on in China, what's going on in Russia, what's going on in other parts of the world. That plays into the public relations or the tension in the markets, and it's good to understand that, have a feeling for that. It applies to currency. A lot of you have families and relatives in other countries around the world. You ever try sending money to those families, or the family send you money? The currency rate, the tariff rate, all these play into what is the risk involved in investing in the markets. What are the markets? Financial markets are a physical thing. They're a place where you take your money and you exchange it for the future. And it can be in physical assets like gold, silver, commodities. It can be in financial assets like stocks and bonds, savings account. I'd stay away from these, but you can invest your money and to determine what you think is going to happen to the market in the future. You can invest in very liquid and very low risk markets like the money and capital markets, where the money is just invested in treasuries, in access to, you can get liquid assets of that very quickly. You can just write a check out of your account and there's the money. Now, for most of us, all our investments in the markets are in the secondary markets, stocks and bonds and securities that have already been issued. They're already out there. Somebody's already owned them. The primary markets are for the Warren Buffetts and for the Bill Gates of the world, to investing in companies as startups, investing in initial public offerings. But once that primary market is finished and the big money changes hand, then it trickles down to us to buy pieces of those financial markets, pieces of those stocks in the secondary markets. And then there's private and public markets. The public markets are the New York Stock Exchange, your banks, your institutions. But there are private markets out there. You can invest privately. You can invest in a private company. You can invest in a private holding company. One of the big things these days is what are called SPACs, where you're investing privately in the context of hopefully that will turn into a public corporation down the road, and you will benefit from that expansion into the public markets. It's called SPACs, but I'm not going to spend too much time on that. That's a little bit too technical, and we don't need to know about that much stuff. But that's the difference between the private and public markets. The private markets is you have a specific vehicle that you can invest in, and it's yet to be public. It's yet to owned by the public entity. And the physical location. I think one of the coolest things to do, and you're probably going to roll your eyes on this one, is if you're ever in New York City, take the subway, take the bus, and go down to the Wall Street. Go down to the New York Stock Exchange. See where all the action is. And your first impression will go, is this what this is all about? Really? Is this it? It's not very impressive. It's kind of small. I mean, what's going on here? Is this where all the action is? It is. The New York Stock Exchange. And then we have other exchanges. American Stock Exchange, the Chicago Board of Trade, Tokyo, Beijing. These are institutions that take your money and trade it with other individuals who want that in either buy or sell. The financial markets are simply put, and we've taken this even in high school and junior high school, it's supply and demand. It's all it is. Supply and demand. Who wants to own and who wants to sell? And where they meet is the ending price. It's supply and demand. And the markets, the stock exchange, is where this takes place. It's also done digitally on your cell phone, on your laptop, on your desktop. You can do this digitally through your brokers, through applications. It seems to be very easy. But because it's very easy, you can make mistakes. You can get in over your head. And you have to be aware of that. Stay within what is simple. Stay within what is comfortable. It's okay to open up an E-Trade account, but keep it manageable. Don't put all your money in that. Keep it small until you feel comfortable, until you really know what's going on. That's important. I leave a boring life. Every morning I get up in the morning and I do two things. I make sure my wife has her coffee and I make the coffee. And the second thing I do is I go to the newspapers and I go turn on the news and I watch what's happening in the markets. Where is my money going? What's the environment that my money is into now? It's called leading indicators. Now, I'm not asking you to study these, but you hear about these all the time and they represent the financial markets. These are the closings of these indicators a year ago, in December, and today, or yesterday, excuse me. And notice you can see a variety of things. You can see how in many cases they've drastically increased or they've drastically decreased over the last couple of years. The first three indicators are the stock markets, the equity markets, owning investments in companies. These are indicators that tells us basically our market indicators. The Dow Jones Industrials is the top 30 stocks as designated by the Wall Street Journal. The Dow is up about 4% this year. Last year it was up about 25% for the year. The Standard & Poor's 500. Standard & Poor's is another company that is designated 500 companies that represent the overall market as an index. And that's up about 3.2% this year. And there's the NASDAQ fund, which is about 2,500 companies that are tracked and monitored through the over-the-counter exchange. And Apple and Amazon are one of the key players, and many tech stocks are key players in this NASDAQ listing. NASDAQ is only up about 1.4% this year because Apple and Amazon have not been doing well lately. People have been selling them. That's a story for another day. The next key indicator that really influences all of us is the debt markets, the 10-year United States Treasury yield. In December, if you lent the government money, you were going to get paid 0.92% in interest. As of today, if you lend the government money for 10 years, you would get about 1.5%. What does that tell you? Interest rates have gone up. Interesting. That usually indicates inflation's maybe on the horizon. Now, the Federal Reserve is going to do all they can to avoid that, but that's something to be aware of. When those Treasury yields go up, that means the cost of getting a student loan will go up eventually. That means the cost of buying a car, the auto loan rates will go up. Mortgage rates will go up. And rates that affect us daily, credit card rates, if we don't pay the outstanding balances, will go up. So those money is becoming a little bit more expensive in the last few months. Something to note. Then the next two indicators of the markets are commodities. Oil and gold are the leading ones. Now, you want to include Bitcoin in this and silver and those other flyers, go ahead. But the old reliables, since I'm an old gangster, I'll go with the old reliables, are oil and gold. Notice what has happened in those markets. Gold has dropped. And then for a lot of us with families and with relatives around the world, the currency rates. The relationship of the euro, the Chinese yuan, and the Japanese yen to the United States dollar. Wondering what's happening to the value of our dollar in other parts of the world in relationship. And it's all just like stocks and bonds. It's supply and demand. Who wants to own dollars versus who wants to own euros? Who wants to own Chinese yuan? Who wants to know Japanese yen? That plays a little bit in the overall market indicators. So again, this class is not designed for you to be able to track and understand these details of these indexes or indicators, but they give you an idea if you want to pay attention and feel comfortable in the financial markets, what's going on. The goal of all this is to understand how this all fits into our overall personal finance. Do we have money to put aside into retirement? Do we have money to pay off debt? And we'll talk about these subjects later on in our workshops. And what money do we have to actually invest, either short-term or long-term? Because are we covered by insurance? Do we have a mortgage or a student loan? Do most of us follow a budget? Do we have credit cards? Some of us are beginning to think about retirement. How does all this play into us understanding? Now, when you first think about this, it makes your head spin. Mr. Hasse, I don't have time to worry about this. Forget it. Are you crazy? I'm going to have to pay somebody to do this. No, you're not. You keep it simple. You keep it basic. And that's one of the highlights of our workshops over the next couple sessions is keeping it simple and understandable and basic, but at the same time, providing return, providing safety and security for you and your family, and to understand what's going on in the world around you. We have a budget and a financial planning session on April 7th where we'll talk about budgeting and setting and having goals and establishing goals in our finances. And it can be very simple. If I was a sophomore in college now, what are my financial goals? Well, making sure I have enough money to put gas in my car so I can go around and visit friends and to get ready to go to school. Do I have enough money to pay for books? Am I earning some extra money that I can set aside for to maybe someday buy something or get an apartment or help members of my family? Or do I have other responsibilities of the future? I'm thinking about getting married. I have a student loan or debt that I have to pay off. Managing these through budget planning, through budgets, through understanding the future versus long-term versus short is one of the topics of that. And then on April 28th, understanding credit, the FICO score, understanding debt. Debt can be a friend, not a foe. But if it's managed correctly and within your comfort zone, that's important. So I think to summarize our events, and we're going to open it up to question and answers and any specific questions that some of you have. But the goal of understanding the financial markets goes back to our very first slide. Keep it simple, understand your goals. Don't have to be fancy. You don't have to invest in all these fancy vehicles. Do what you feel comfortable in. If you want to buy stock, you want to participate in the equity markets, if you got that kind of money that you can afford to lose, I might add, then put it in a mutual fund. Put it in an exchange traded fund, which is an ETF, which is just like buying stock in multiple companies. There's a lot of ways to do it to keep it simple. And that's one of the things that we're trying to do here in our workshops and in the Laverne community is make this information available to the community. We're going to have a YouTube site with videos and information for you. You can ask me questions and send questions along to Sarah or the Lewis Center, and we can answer those questions for you. We can set aside time where we can give you guidance and answer any problems or issues you may have. This is one of the great things about getting grants and being able to access our community is being able to make these resources available for just the basic fundamentals. And so you feel comfortable and can learn from this. One of the things I fault our education, I hope we don't have any Lefetre College people here. One of the things I fault our education system is when we're in junior high school, when we're in high school, we don't really teach much about finance, about investments, about budgeting, about credit. And these are things that help us just feel more comfortable in our surroundings. We don't want to be hotshot investors. We don't have the time, but we just want to understand where we can maximize our return, our net worth, understanding our debt position, how to pay it off, and move forward to a comfortable life. That's the bottom line. So, Sarah, thank you for popping back on. I opened the floor up. I got done right on my exact time level, leaving about 20 minutes for question and answers. As anybody, I open up the floor to any questions or concerns or comments from anybody, please.
Yes, thank you so much. Lexi, if you would do me a quick favor and just repaste the link so that folks who joined us late could mark their attendance. If you would just go ahead and click on that link if you haven't already, that would be wonderful. But otherwise, we are going to open it up for questions, and I have a couple prepared if people want to sort of warm up. So I will start out. What happened with GameStop?
Oh, well, I could spend 2 hours about that one. It was a speculation. It was a certain group of investors using a social media site called Reddit getting together, and I don't want to use the word plot, but getting together to price up and bid up the price of the stock of GameStop. The reason for that is that they caught wind of the hedge funds and major investment houses going short on that company. That company doesn't have a very good track record. They're losing money. They're losing market share. So a lot of major investment houses were what is called going short, meaning they were betting that the price was going to drop. All right. I don't want to get into all the technicalities about this, but so these people in these social media sites said, let's, excuse my French, let's screw those investment houses by bidding up the price of the stock, making them lose all that money in anticipating that the stock price would go down. Now, since then, this was all a couple months ago, but since then, people have learned more about this company, and the company has maintained a pretty high level of stock price. People think this company can turn it around. By all this stock price going up, this company's been able to get some more capital from investors, from banks, and are trying to make that company a more viable, profit-oriented business. And now that's where we are today, and that stock continues to do fairly well because all this new capital and all this public relations developed by this. But the bottom line, Sarah, to your question is it was strictly the little guy trying to nail the big guy in the marketplace. And that's exactly what it was.
Thank you. It was fascinating to me to watch that. We have a question from Carla Espinoza. She says, how do you know when it's the right time to invest money in stocks? And is there a right amount to put in stocks?
Ah, great question. And I'm going to I'm going to give you an answer that you probably don't want to hear. You never know when is the good time to get in stocks. Okay. It's up to you. All right. If you have some extra money that you can afford to either win or lose with, it's a good time to invest in stocks. All right. I always make sure, and again, don't anybody go by this. This is my own personal preference. And again, investing in the markets is personal. You're not a bunch of sheep just following somebody. It's personal. If you have some extra money that you can afford to not have for a while, then go into the stock market. But if you have bills coming, if you have student expenses coming, if you have repair on your automobile coming, don't put money in the stock market because you're just going to have to sell it anyways to use it for those things, and you might take it for a loss. So the good time to get in the market is when you feel comfortable, and there goes to the leading question of how much money you should be. I always go by, if you have $200 and you're willing to part with that $200 for 3 months with no questions asked, you don't have any commitments, at least 3 months, then invest in stock. All right. Now, people out there are going to say, well, Mr. Hasse, what about day trading? What about, well, that's a little bit more sophisticated, and that's a class for another time, day trading and all that. But to answer your question, it's the good time is when you feel comfortable and you can afford to live without that money for a while, and then expect what happens as what the market does and what's going to happen. Now, as I said earlier, we have all this new money coming into our economy in the next couple of weeks with the stimulus checks, with the government going to be passing some more legislation for infrastructure. Anybody drive on the roads lately, especially in the Midwest and the East Coast? Good God, the bridges are falling apart. So there's going to be a lot of money being spent on infrastructure. A lot of money in another year or so, people are going to be back traveling. Airlines, hotels, not now, but down the future. Think about that in investing now while those investments are fairly cheap. But you got to hang in there. You can't say, "Oh, I'm going to put money in MGM Grand Hotel in Las Vegas," knowing that people are going to start going to Vegas again. Well, it's going to take a while. It's not going to happen overnight, and that's what you need to be aware of. Okay.
Oh, it's great. I really appreciate the kind of zoom out perspective on the stock market as part of our whole social universe.
Mm-hmm.
So we have a great question from Crystal. Thank you for the information. How does one get started? Is there a website that you would recommend or a company?
Well, here's a great way. Now, if any of you have a checking account at Wells Fargo, or any of you have, you're familiar with Wells Fargo, or if you have a bank account at Bank of America, or even if you have a credit union account. For the novice investor, the best place to start is go to your bank who knows you, you're a depositor. Go to the bank who somewhat knows you or you're familiar with their website, and look at the stock buying or investment opportunities available to you as a depositor through the bank. That's one way. Now, if you're computer savvy, if you're tech savvy, and you feel that you can make your own decision, then get an E-Trade app, open up an E-Trade account, open up a Robinhood account. There's fees involved there, even though, Mr. Hasse, there's no fees in Robinhood. Yes, there's fees in Robinhood. You just don't know them. You're still paying for them. But if you feel that, then open up an app if you feel that kind of savvy. But the best place to start for just the beginner is to feel, again, back to the simplicity, common sense, comfortable. Go to places that you already are familiar with, your commercial bank, your credit union, and see what they offer in services to buy and sell stock. That's where I would start.
I think you just answered the next question, which is which stock apps do you prefer? So I think
they're all about the same, because here's how stock apps work. They entice you by it being so convenient. It's like playing a video game. Okay. I was going to maybe bring up my Robinhood account here today, but I thought, nah, I don't want to do that. But they make it seem simple. And where they make money is they sell their trades to a third party. and then that third party pays Robinhood the access to operate the trade. That's where the fees come in. Basically, the stock price and the change of the stock price that they give you and what is negotiated in the final trade, is the difference is the fee. Now, you don't have to pay it, but you're losing some money there in the transaction because they're playing with the stock prices at the closing of the trade. Now I'm getting a little bit technical there. So every company is the same. E-Trade, Ameritrade, all the apps, they're all about the same. I like the Schwab, specifically. I like the Charles Schwab application and the stock trading for Schwab. That's very convenient, very easy. In some cases, though, you have to put down a deposit of $1,000, $1,500, which some of us don't have to spare. With Robinhood, you can start trading immediately with no deposit. Okay. So again, but again, to keep it simple, at these places like Schwab and E-Trade, they make it very easy. They explain it to you and walk you through it. Robinhood's a little bit more, you got to kind of know what you're doing. So it depends on your how sophisticated you are and how much you want to really spend on this. If you want to be able to spend a lot of time on it, then go a little fancy. But if you want to keep it simple, the Schwab account are very easy to manage. But I would just dabble in those. Have a professional through your bank, through a brokerage house. They're going to charge you fees just like the day traders or the stock applications, but they're a little bit more physical. You can talk to them, you can see them, you can deal with them. It makes it a little simpler.
That's really helpful. Thank you. Our next question is, if you're investing for a long term and if you don't know how to pick a stock, is it a good idea to invest in a low cost index fund like the S&P 500?
Exactly right. It took the words right out of my mouth. Because when you invest in a low cost mutual fund or an ETF, the low cost means there's very little fees. You put your money in, it's grouped with a bunch of other investors, and you all buy pieces of companies. And then you share in that. Like an index fund is you're investing in the companies that are in the Dow index. So if you see today the Dow went up 4%, in my index fund, I'm going to make 4%. You know exactly how you're doing because all those stocks are in relationship to those funds, like the Dow, like the S&P 500, like the NASDAQ. They all follow them. It keeps it simple. And the reason why it's cheap is because the investment decisions are made by Dow. Investment decisions are made by these organizations. So it keeps the overhead down for the funds managing this. And all basic you are paying for is bookkeeping charges for those organizations to keep track of everything. So that's why, exactly right. Those are the cheapest forms of getting into the market. Buying in an index fund, you can do that through your commercial bank. It's very easy and it's very safe. Yes.
So the next couple questions seem to kind of go together. Brittany asks, will there be any classes on how to read a stock's financials? And Jemima asks, yes, can someone explain how to read SEC filings?
Well, take Professor Hasse's finance class and you'll know exactly what's going on there, or take Accounting 201 and we learned how to read financial statements there. But be that as it may, I think one of the best things to do is, and I'll put these up on our YouTube site. I have a couple of nice videos, fairly simple, that you can click on. It'll walk you through an SEC 10K filing. It'll walk you through the financials of what to look for. Naturally, when you're looking at a company, you're concerned about profits and trends, the history of profits. Profit margins. You're concerned about cash flow. Are they generating cash flow so they can pay off their debts, pay dividends, pay that? It's called creating value. And that value is related to the stock price because the market sees this and they say, hey, I want to buy that stock. They're doing okay. And so understanding that, you take advantage of it. Now, here's the good thing about index funds. Here's the good thing about getting into low-cost mutual funds. You got people doing that already. You don't have to worry about it. They'll buy and sell for you, knowing these trends and seeing these in the financial statements. But you can do that yourself by understanding that, by reading their 10K reports, or even, keep it this simple. Go to Yahoo Finance. Yahoo Finance is for everybody. Go to Yahoo Finance, type in the name of a company that you're interested in, and see what they tell you about the company performance. Right? You can read it right then and there. It's very basic. It's not sophisticated, but it gives you a general idea of what's going on with that company. That's kind of good.
Thank you. Kathy asks, what about the Charles Schwab stock slices? What is your take on these?
I think they're very good. If who can afford $4,000 for Amazon stock? Okay. I know Sarah is about the only one here that can afford that. She can go out and buy as much Amazon stock as she wants this afternoon. But for most of us, we don't have $4,000 or $3,000 laying around, or we don't even have $550 to buy Tesla. We don't have that kind of money. So slices are you just take, oh, I want to put 20 bucks into Amazon. And so they take the closing price of the stock that day and take $20, and what percent of that $20 is of that stock price, that you get a decimal. I'm going to buy 0.00045 shares of Amazon. That's a slice. And as that stock trades going in the future, you get up that specific percentage of the return as the stock price changes. It's like getting a slice of pie. The bigger the piece of pie, the more weight you'll gain. The smaller the piece of pie, the less weight you'll gain. It's the same thing with stock. You put in more money, you'll get a bigger slice, and you might earn more. But if you're kind of new at this, oh, I'll put 20 bucks in. Who cares? I'm going to own so much, a small value of that stock. Even if the stock goes down, whether I'm going to lose $20, big deal. That's the advantage of those slices.
Well, at the Lewis Center, our approach to well-being is pie friendly, in case anyone is wondering.
I kind of like that. I like that.
Everything has its place. Let's see here. Andy asks, do you have any favorite personal finance books?
Any personal finance books? Not really. And if this is the Andy I think I know, this is the Andy who's a graduate of the university, who I had in a very numerous amount of courses and a great student. And Andy, thank you very much for attending. I don't have any most of my financial favorite books are are books about the market history, like Going Short, or books that talk about the stock market crash and that sort of thing. I don't have any specific books that tell us about trading or that sort of thing, because you know why? The world changes daily. Every day the markets change. Every day the economy change. I mean, just think what has happened to us in the last year, with the pandemic, and how our lives have changed. So learning the fundamentals about stock are pretty good, but the world changes. So that's why I don't really have any favorite books, Andy, about the subject. I like reading about history of the markets. I like reading about things of the past. And then that kind of gives me indicators of how the markets or how the world reacted to these. So any book on the history of the markets, or books about specific challenges in the markets are good to read, but I don't have any specific book about how to do things. No.
We need your book.
Yeah, I wish. Read Rink Rats every couple of weeks. I give you a lot of market data there. I shouldn't have said that. That's a plug for me. I shouldn't say that.
No, please, if you want it, please put it in the chat if you'd like. Okay, I see from Teresa, Rick, you're always top drawer in delivery and sharing of your wisdom and knowledge. Well done with engaging with all the questions. So that's just some positive feedback.
Well, Teresa's a colleague, so I ditto back to Teresa. Thank you, Teresa.
I have one other question, if no one else has any that they're putting in the chat, which is that I'm really curious, kind of in the landscape of these apps that have come about, like Robinhood, or I use an app called Stash Capital.
Yes. Oh, yes.
Mm-hmm. Has that sort of changed the working landscape for traders in general? It was really interesting for me to hear about the third party and how the kind of fees are built in. But has the app sort of challenged any of the structures of how trading was done before their existence? Do you know?
And not to sound trivial, Sarah, not to sound snobbish, but no. Because again, we are all, as investors, you and I, who are buying slices and putting our fairly small amounts of money, we really have no influence on the market. The market is big players. The market is, if anybody's a staff member at the University of Laverne, the market is Fidelity. The market is TIAA CREF. That's the markets. Those are the players. The market are the big insurance companies. The markets are the big hedge funds, Blackstone. Markets are the big players. They drive the markets. They drive everything. What we do is we're now through technology, through apps, making it accessible to us to think we're players. Okay, there's a key word. We think we're players. We're not. Trust me. We're just sheep following following the markets. Now, yes, if we get sophisticated enough and do our homework, we might be able to find those little niches that a lot of people don't know about, but that takes a lot of work and a lot of time. A lot of us are just more concerned whether we're going to be back in the office this summer. A lot of us are more concerned whether we can what shopping we have to do this week. We don't have the time to concentrate on these big player decisions, and that's why we pay somebody else through these fees with brokers and these slices so they can do that for us. So don't get a big head about this. If you download a few apps and you think you're like Warren Buffett trading stocks and you're going to be you might do well, but you're not affecting anything. You're just a player, and you don't have much say in what's going on.
It's always good to end feeling small,
Yeah, sorry. But knowing that, Sarah, that's a good point. You know where you are. You know your way where you are in this. And that's a big reason why you make the decisions, because don't get a big head. Don't think I got a hot tip. I'm going to make a killing. Next thing you know, you're taking money out of your credit card account to pay back the money you just lost on the stock. So you got to be careful, but knowing your place in there, you can be successful. You can be successful, very much so.
I'll say too, for any staff or faculty on the call who use Fidelity for retirement savings, it was very easy for me to open a brokerage account with Fidelity because I already had the website for the retirement account.
Mm-hmm.
So that's just a tip for faculty.
And when we get into our financial planning, we're going to talk a little bit about retirement and those kind of vehicles, and look at Roth and look at 401ks. And we're going to talk about that in our next session.
Well, that's a perfect lead in to say that we have, as Mr. Hasse shared, a couple other great sessions happening this semester in April. And I think, Lexi, if you get a chance, if you could put the link to Campus Labs in there if people want to register for those future sessions. I heard some great data yesterday that it takes at least 10 hours of financial literacy education to start really making a difference in people's financial behaviors. So I would challenge you to start adding up those hours of financial literacy education, and what we're offering here in the YouTube playlist that Mr. Hasse has given us, which is such a great resource, and in all of our workshops to come. So I don't know if anyone has a final question, or if Rick, you want to say anything else, but otherwise I think we're wrapped up.
Well, I just have one final point to everybody. And again, thank you very much for attending. This is a good thing for our community to feel like we're one, to feel like we're all kind of in the same game, to feel better about money and investing. That's the purpose of all this. It makes you feel better, feel good about yourself. And that's important, especially these days when so many things are going on around us. And also, I urge all of you, please, one of the great things and one reasons why I'm associated and want to be associated with Laverne is we have staff, we have faculty that can help you. It has nothing to do with our classes. It has nothing to do about anything. But if you have questions, concerns, it doesn't have to be me. Give Avo Kashishin a call. Talk about somebody who should know the markets. There's a guy right there. All right. And other people. We're here to help you. People in the HR office can refer you to the Fidelity and to the TIAA people if you're staff. Students, try to get your parents involved in understanding the markets. I grew up in a house like Sarah mentioned earlier. My father was a businessman, but stock markets, investing, he had known nothing about it. All his money was going to his business to keep it going. He didn't know anything about this. And so this is a great thing within your own families to understand, to talk about, to feel comfortable with, so everybody understands what's going on with money. I can't think of a better thing to encourage family relationships is understanding money, right? So that's a key thing. So please take advantage of the services we offer here. If once we get back on campus, please feel free to contact me via email, and we're here to help you and make things comfortable and your lives better, and that's important. Thank you.
Thank you so much for those really important final points. Please join me in giving a virtual round of applause to Mr. Hasse for giving so generously of his wisdom and time. Thank you. I will stand back in the Zoom room in case anyone has any questions about these workshops. Otherwise, please enjoy your night and thank you so much.
Thanks, everybody.